critical week for U.S. markets with jobs data, a Fed decision, and earnings from two of the biggest stocks in the S&P. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and
Welcome
I came back for the right week. Yeah.
I know.
Earnings, Fed, and jobs.
I'm just surprised you came back. I heard you went someplace really exotic, and you decided back here in the studio with Romaine is where you
wanted to be. It was like Punta Cana or Romaine. I mean, it was no choice. All right, here's where we stand here within the markets. The S&P is up by about 0.1%, but we're sitting sort of just below the 50-day moving average, and retaking that would be quite something. Tesla, the best performing stock within the S&P. What this just tells me is it doesn't take a lot for Tesla to move a lot. Any sort of good news, maybe you can see that short covering, and I wonder if that's what we wind up seeing today. 10-year yield down by 4 basis points. You see a lot of buying coming in all across the curve, but particularly at the long end. We're going to get a refunding announcement any minute now, and it is the currency cross you got to pay attention to. Dollar yen 160. Couldn't believe it, Romaine. Woke up, saw that number, and now we're back down to 155. What a roller coaster. Yeah, the one day, Alex, where I care about the yen, and you're out partying in the Caribbean. But let's start with big tech here, because a big question about whether big tech enthusiasm from last week actually carries over into this new week. Now, Apple and Amazon are scheduled to report over the next few days, with investors really hoping for more evidence that technology company profits can indeed keep propelling stocks higher. Morgan Stanley strategist Mike Wilson, though, he says that while the share of companies beating analyst profit estimates has been strong, the share reaction, meaning the prices, that's been muted as valuations were already inflated. We're going to come back to that in just a second. He sees pressure on stocks from higher interest rates. The 10-year yield, remember, which in February was trading as low as 3.8%, has since reversed and now remains perched around 4.6%. Now, it is possible, maybe even plausible, that equity investors this week do get some relief from those higher rates. While the Fed on Wednesday has telegraphed no intention to change its course, it is expected to tweak its quantitative tightening program, a program that so far has forced the Treasury to sell more debt to the private sector. Now, that's put a lot of upward pressure on rates. Now, the anticipated changes by the Fed are coming just a couple of days after that Treasury refunding announcement that Alex was just talking about. Those numbers just coming in, they were actually higher than expected. And we're going to get to that in just a second, because that announcement is really about whether the Treasury was going to stand by the January guidance that it would hold off of further increases in its refunding auctions, which now sit just shy of record sizes seen in the COVID crisis. And once again, crossing the terminal right now, they did not stand by that January guidance. A lot going on this Monday that we have to get to today, Alex. But our first guest that we actually have up, he's actually saying, look, this isn't about the Fed. It's not about the Treasury refunding. He's laser focused on Friday in that U.S. jobs report. And we got a lot to get to before we get to the jobs report, right? We get JOLTS coming out. We also have the ISM and all those nice little clues to the jobs report. Here's where we stand with the whisper number. So this is WHIS. Go on your terminal. You can submit where you think the jobs number is going to be, and then we nicely chart it for you on the terminal. And this is where we're at. That's why we call it whisper number. We're just a little bit higher than 130,000, which is lower than overall expectations that you look at for the jobs number, coming in at 240,000. So a teeny bit lighter than you would have thought. So come on, make your point. Let's go in. Let's see what this winds up moving. We get JOLTS. Like I mentioned, you get ISM. And there's a lot going on with it. One, the churn is not as good, right? You also wind up having a lot of people, particularly in the tech sector, out of work for longer. And you also have small business hiring kind of taking a little bit of a pause. So a couple of flashing yellow lights there, Romaine, for the jobs number. All right, let's get it going right now with Ian Lyngen, head of U.S. rate strategy over at BMO Capital Markets, helping us kick us off to the close. And apparently, Ian, this is going to be a kickoff, I guess, to Jobs Day. Looking at your latest note here, you're basically saying the Fed, Treasury refunding, all that takes a back seat to what we're going to learn on Friday.
Well, I do think that we know a lot about what we're going to hear from the Fed. We know a lot about what Yellen can and can't do in terms of the Treasury refunding. And the only potential real surprise is if Powell were to suggest that the Fed's reaction function to the realized data has changed. And we just don't see that happening. So we're back in data watching mode, which really means it comes down to where do payrolls print and what do average hourly earnings look like for the month of April?
Without really getting too in the weeds here of maybe what that number shows, why do you think a one report would change or maybe not change, I guess, the course of the Fed?
So I think that at the end of the day, what we're looking at is another confirmation of status quo for the Fed to continue delaying rate cuts indefinitely. Because yes, the Fed wants to start normalizing rates, but the labor market has been too resilient and inflation has been too sticky. And if we don't see a disappointment on Friday or an increase in the unemployment rate that no one is expecting, then I think that at the end of the day, we just roll forward to looking at the next CPI print.
So, but add in the dots from the refunding, though, for example. So you're looking at April to June borrowing estimates now, $243 billion because of lower cash receipts, right? And there's a conversation about, are we going to pare back QT? And are we going to start hearing that from the Fed? If you put those two things together, what does that mean for the Treasury market?
Well, lower QT implies that the Fed's going to be rolling over more of its portfolio, which ultimately means there's going to need to be less issuance from the Treasury Department through the private market. So that's a net good. The flip side is we were looking for $177 billion, so a bit of a downtick in the amount of borrowing needs for the current quarter. Now we got a bit of an uptick, which means the big question is, where does Yellen choose to access that funding? And we've already been told she's going to use the bill market. And as long as the bill market is the stopgap, then it really doesn't mean a great deal for the broader Treasury curve.
So do you think that the 10-year hits 5% or 3% then first?
I think that there is, for proximity alone, there's a much higher probability of hitting 5% before 3%, but I don't think we're going to 5.25.
Talk to us a little bit about how FX sort of folds into this. We talk about the resurgence, or at least the recent resurgence that we saw in the dollar. I know that's complicated a lot of things for folks overseas here. How does that fold into your outlook?
So at the end of the day, a stronger dollar is a net positive for the Fed when the Fed is attempting to stop importing or avoid importing inflation. Instead, we're importing deflation. Now, eventually, it becomes problematic for the export sector, which was part of the story that we saw during the first quarter, where net exports were a pretty significant drag on growth. In terms of balancing those two, I think that the dollar and the statuses of the reserve currency, even frankly, has taken a back seat to what's going on in realized inflation and the resilience of the jobs market. The Fed really can't do much else but stay on hold.
This gets to a broader question, and I know you don't really cover, like corporate equities and at least the corporate earnings side of it here. But when you look at the performance of these companies, I'm talking about their balance sheet and their income statement performance here, it seems to belie this whole idea that you're seeing softness in the economy. These companies are still growing. They're still producing profits. Does that not then become maybe a headwind for the Fed's decision?
I think you're precisely right. I think it is, as long as risk assets continue to perform and perform well, what we'll see is the net result being easier financial conditions, which pushes back against what the Fed is trying to accomplish. And perhaps more importantly, there's a wealth effect argument. As asset prices appreciate, whether they're homes or stocks, people feel like they have a greater capacity to spend. And I'd also make the observation that when we see headline revenues grow as well as profits grow in nominal terms, it's important to keep in mind that part of that is reflecting what's going on the inflation side because people don't report profits in real terms.
Okay, so wrap this all up for us with a trade. What is the best way to express these views that you have in the market?
I think that at the moment, fading any attempt to price in rate cuts sooner rather than later is ultimately going to be the right trade. When we know that the Fed has all the evidence that we need, we'll eventually see that cyclical re-steepening of the curve, and that's the curve, or that's the call that I think most people have been waiting to come to fruition, and it certainly has failed to materialize thus far.
Yeah.
All right, Ian, always great to talk to you. Ian Lyngen there, who leads rate strategy over at BMO Capital Markets, helping us kick off to the close here on this Monday afternoon with a look ahead to those bells and earnings out of Paramount. But of course, it's not going to be about the numbers. It's going to be about Skydance sweetening its best and final offer for the media giant. Details ahead of the company's latest results, Alex.
All right, plus a sit down with the CEO of Chevron, Mike Wirth. It's his view on demand, M&A, and much more after earnings from Friday.
And a silhouette shift? I have no idea what that means, but our next guest, Barclays analyst Adrienne Yih, going to help to shed some light on that, as Lululemon may be at risk of shifting consumer trends. That's our top calls, and it's coming up in a bit. Stick with us. A lot to go here on The Close on Bloomberg.
One stock in the move is Paramount. Shares are up 3%. The takeover deal hanging in the balance here. The CEO, Bob Bakish, could be replaced as soon as today as the Redstone family and David Ellison of Skydance offer concessions to make a possible change in control more appealing to the company's other investors. Ellison is proposing to buy a $3 billion block of shares at a premium, and the Redstones agreeing to let non-voting shareholders approve any possible transaction. You all got that? Makes perfect sense, right? Here with the latest is Bloomberg's Chris Palmieri out of LA. Chris, I've been away for a week. I came back, read the headlines, and I'm like, my gosh, this is a hot mess. Will it be more or less of a hot mess by 4:30 today?
More.
More, excellent. What are we going to learn?
Well, I could just say over the weekend it was a busy one. As you noted, the Skydance and producer David Ellison basically almost doubled the amount of money he was going to invest in Paramount stock from $1.5 billion to $3 billion, as you said. And they'll be buying those shares at a premium. We don't know exactly what it is, but typically these cases are about a 20 to 30% premium to the market value. So that's the B shares. What they do with the money is going to be discussed still, whether it goes all to, or the majority of it goes to pay down debt, or whether some of it does some more share buybacks. That's going on as part of this new offer. They're, this is a complicated transaction, but they're going to give the Redstone family a little less when they buy out their National Amusements business, which is the holding company for their Paramount shares. But this is all still tentative. As we reported, the Redstones are sort of feel like they can give the minority shareholders a vote on this, although that has not been definitively decided. So much is up in the air.
So much is up in the air, Chris, but this gets to the idea, if for some reason Skydance doesn't come through, is there an option out there, a viable option out there?
Well, we've been told that Apollo is still interested. They may come back with a more formal offer that involves Sony Corp.
Would that get approved with Sony Corp attached to it? Would that pass antitrust scrutiny?
It would certainly be subject to more antitrust scrutiny because you'd be merging two Hollywood studios, and probably one of them would not stay. The lot and all might be sold. And also there's more issues with foreign ownership of a domestic media company, given that Sony is a Japanese firm. So there would be probably more regulatory hurdles, not insurmountable, but more.
Why do you think that Bob Bakish would lose his job?
He's already, well, number one, look at the stock price since 2021. It's gone from almost $100 to 12 or so today. He has lost the confidence of a lot of board members in the Redstone family at this point. There was a lot of opportunities to sell assets. They had offers for the Showtime cable networks, for BET. He ultimately decided not to sell them. He has also not been a fan of this transaction with Skydance. Not hard to believe, since he would lose his job either way. So for that and probably other reasons, he'll likely leave.
All right, Chris, a lot of drama there, and unfortunately, I don't think any of it's going to be about the numbers. It's going to be about those folks on the screen there. Chris Palmieri over at our Los Angeles bureau at Bloomberg, and I'm fascinated by this, particularly now that we kind of know that there's some tension there with Bob Bakish. And look, if you're going to get this thing done, I hate to say it, but I think certain people need to be out of the room.
But I love that we spent that whole segment, and we're going to spend this at 4 o'clock too, not talking about the actual stuff, like TV revenue, the entertainment revenue, direct to consumer.
We'll be bad.
That doesn't even matter anymore. It's just like, how do you save a company that should have been maybe broken? You could make an argument should have been broken up before and wasn't. Yeah,
it should have been. And I think more importantly gets to this idea that this is kind of, you talk about the performance. One of the reasons the performance is so bad is because this is kind of unresolved. Maybe if you had a little bit more clarity and management there that were really going to be there long term to see this through, you can right that ship. So I think that's why investors are kind of skittish. They want to see this done sooner than later. We're going to talk a lot today, of course, about Paramount and what's going on in the world of entertainment. And speaking of which, over at McKinsey, executives are using the likes of Eminem and Bob Marley to boost morale. Have you seen this story, Alex?
Yes.
So basically, McKinsey, which is probably like the most vanilla of vanilla companies out there, is basically saying, hey, look, you know how we can sort of boost morale around here? Is to play, hip hop from, 20 years ago and reggae music from, 30 or 40 years ago.
So apparently this was an event back in mid-April, and partners were encouraged to go and air any concerns or misgivings about the firm's direction to a soundtrack of rap and rock.
Yeah.
And to top it all up, to go green, they were like pushed to maybe bike or use like a scooter to get there so they wouldn't deal with emissions. What?
So is this like the consulting equivalent of like, hat turned backwards and how do you do, fellow kids?
Yes,
Yeah,
but like, what is it? Like, who was sitting at the table and was like, this is going to do it, guys? Eminem is going to change our feelings in the office.
You know who was sitting at the table? A bunch of McKinsey consultants came up with this idea. We love McKinsey, by the way. All right, stick with us. A lot more coming up here before we get in trouble. We're going to move on and talk about Lululemon. Barclays delivering a downgrade there. We're going to talk to the analysts on that call about the risk of a silhouette shift. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Apple, an upgrade to outperform over at Bernstein, with the analysts saying the shares have actually derated significantly due to that weak iPhone 15 cycle and concern about demand in China. He's telling investors, quote, buy the fear, and says the current weakness is more cyclical rather than structural. Shares of Apple having a pretty good day, up about 3%. Next up, Shopify raised a buy from neutral over at Citi. Recent channel checks by the analysts from employees, customers, partners, and competitors signaling a stronger e-commerce backdrop for the online retailer. The analyst touting his confidence in Shopify's upcoming earnings report, which is about a week and a half from today, and the long-term growth potential heading into 2025. Those shares a modest bid on the day, up about 0.8%. And finally, let's get right to it with Lululemon. Barclays cutting the athleisure company to equal weight from overweight and slashing the price target down $395. The analysts over there, Adrienne Yih, and her team are seeing what they call a silhouette shift in teen and young adult clothing as consumers and brands opt for a little overbig fashion trends. Tweaks to sizes and colors may serve as a short-term fix, but Yih ultimately sees the company taking a hit long-term. Those shares taking a modest hit today, down 0.8%. Those are our top calls here on the day, but we do want to stick with Lululemon, and I'm pleased to say that the person behind that call joins us right now, Adrienne Yih, U.S. Retail Senior Analyst over at Barclays. All right, Adrienne, let's get right to it and the silhouette shift here, because I guess Lululemon, it was all about tight yoga pants and relatively svelte, tops. And one reason why I never even shopped there, Adrienne, for years, because I couldn't fit into any of those things. Now you're telling me that finally that I've lost some weight and can finally fit into their stuff. Apparently, we're now all going back to baggy clothes.
We're going back, Romaine, we're going back to real clothes. That's first of all, we're going back to real clothes. So the silhouette shift is actually based in denim. And we've been in a denim cycle that what I'll call big over little, so the skinny leg denim paired back to like a biggish top. We've been in that since 2007, for the greater part of about 17 years, which is kind of shocking. And so the emergence of these wider leg, baggier flares, right, the denim bottom has sort of started in 2020, 2019. And 5 years on, right, you're actually getting the transition from early adopters to mass adoption. And that's why it's starting. That's why this year it's going to start to be felt as sort of a real dollar a wallet shift.
Well, this is what I'm curious about, because I understand that Lululemon has kind of staked its sort of aesthetic around a more slender cut here. But are they not able to sort of pivot fast to a trend that maybe is a little bit baggier? Do they not have that capability?
They absolutely do, but it's two different things. So there's the actual shape of the bottom, right? So you see that they've had sweatpants and they've moved on from the legging, flare legs, et cetera. So they've done a great job in the athleisure category. But I think, part of the call here is that people are going back to real clothes, right? They're actually not hanging out all day long in their athleisure wear. And so this is kind of the first post-COVID transition that we're actually seeing people go back and buy legitimate traditional apparel based and grounded with denim. It starts with the denim bottom.
Well, and then to that point, like if you work out, you have to have workout clothes because it helps with the wicking and the sweat. And if you're with a trainer, they need to see how your body's moving. Like that part makes sense. But then the athleisure part where I'm wearing it to go pick up my kid, that's the part that's changing. So who's going to benefit from that part?
Yeah, and that's the part where if you think about the cohort of new entrants, right, over this COVID period, they really got younger and younger as more of these kind of 15 middle school, high schoolers were staying home and playing sports. The entire like teams, right, of these kind of middle schoolers and high schoolers would be clothed in Lululemon. So I think what you actually got over the past 5 years was indeed you got the age range to come down about a decade, which is great for lifetime value of the customer, but it creates a little bit more of exposure to this more fickle teen. And that's where we're seeing this trend movement where they're on an allowance, they're on a budget, and the incremental dollars, right, to get this new wardrobe that they need are coming out of someplace else within the budget. It's not about the bad consumer. It's about shifting dollars within the wallet to something that you don't have versus something you do.
So what's this worth to Lulu on the downside?
You know, right now, Lulu had already guided down, right? So on their last call, they had guided to kind of 10, 11% top line growth from an algorithm of about 15%. So a little bit of a haircut there. Most of the pressure is coming from the US with upside coming from China. So where we went, we basically think that there's little upside to the earnings, right? When you want to be long a stock, you want it to be a multiple against upside raised earnings. And so that's really where we are. You know, multiples come in. I don't think you're going to get more contraction on the multiple. But again, we don't really see the upside earnings, and that's why we went to an equal weight.
All right, Adrienne, always great to talk to you. Good stuff. Adrienne Yih, really all over this. Of course, analyst over at Barclays covering Lululemon. And I should point out, too, I mean, I was kind of joking about, I mean, I didn't buy like the tights and stuff, but they actually have some really good shirts that are great for golf. And that was kind of my entry. And
okay.
yeah, actually another golfer like tipped me off to it.
How much are they?
Expensive, but they were, but they're, they wick away this, whatever technology.
Yeah, wick away
and they're
is fun,
great,
sure,
but they're breathable, they're great. I bought one, and then I went and bought like 2 others because I'm a creature of habit. But now, I don't know. Now I feel like I'm just behind the times.
I feel like the golf stuff would be different. We have to ask Adrienne, but it feels like that's a different thing than the athleisure wear situation because you actually will use it and pay money for it. But couldn't you go to like a TJ Maxx and buy a wick away Nike shirt for like $20?
No.
Yes, you can absolutely do that.
TJ Maxx.
This is,
What?
Yeah, designer store.
What is that? Is that where I have to like rummage through like a garbage bin or something to get it?
Okay, fine. You want to pay $300
I want everything
for
on
a
the
golf
shelves,
shirt?
nice and neat.
Go for it.
A little personal shopper.
Oh my gosh, it pains my soul. All right, coming up, let's go to something that's going to help my soul, and that is Chevron. The stock report had earnings. The company had earnings after the bell, before the opening bell on Friday, and we talked to the CEO earlier today. Mike Wirth, CEO and chairman of Chevron, will be joining us next. That stock is up by 0.1%, and it is really the upstream in their operational and production venue that did really, really well in earnings. We'll also take a look at its deal for Hess and kind of where it stands in arbitration now with Exxon. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Okay, so I was gone for a week. What was the biggest thing I missed? Your takeaway for me?
Well, the market got its mojo back. Remember you had the big sell-off the week you were here, and then, they managed to post some decent gains last week.
Okay.
I know.
So I kind of missed nothing.
That's about pretty much.
It kind of went like this.
So that's that. You missed some bad weather in New York, so it's good that you were away.
Probably better that I was away.
Yeah.
I also missed oil earnings for the big guys, which I did feel genuinely really bad about because Exxon, Chevron, I like covering them. But we did get to speak with Mike Wirth today.
Yeah, we did.
A day after earnings. So Chevron beat expectations for a second quarter. The company increasing global production by 12% versus a year ago. Its upstream side of the business was super solid. Now going forward, though, it's all about its acquisition of Hess, and that's mired in arbitration with Exxon. So we spoke to Mike Wirth, chairman and CEO of Chevron, and asked him about, we started off by talking about the short-term Permian production outlook.
We just continue to see productivity and efficiency gains, and we're getting more production out of the same inputs: wells, completion, rigs, completion crews, et cetera. So we expect to be, relatively flattish through the first half of this year. Growth in the second half to exit over 900,000 barrels a day, on our way to 1 million barrels a day in 2025.
So that's really back half weighted. Why is it back half weighted? What's going to sort of change?
Well, we're bringing another completion crew on in the middle of the year. So right now we're building up an inventory of drilled wells that are not yet completed, and then when that rig comes in, we'll start to put those wells on production. So it has to do with optimal capital efficiency as we bring equipment in, and nothing unusual. It's really part of the normal program there. It's not a straight line every quarter.
You guys announced potential ambitions there in Nambia, an operating stake there in one of the areas, License 82. What's your outlook for Nambia? Like, what do you think that's going to look like? How invested do you want to be? How aggressive do you want to be there?
Well, it's certainly a basin that has seen some early exploration success by others. We've got one large block off Namibia that we expect to put an exploration well down in late this year or early next year. We've just acquired a large interest in operatorship in a second block there in a basin that has some of the signs of things like we saw in Guyana a decade ago. So there's a lot of work to be done, and there's no guarantees in exploration. But we're always looking to bring resource into our portfolio through exploration, through technology, and then also through M&A. And in any given period of time, the balance of those may shift around. But fundamentally, we need to be good at all three of those over the long haul in order to continue to create value.
Galp announced a big discovery in Nambia last week and is rumored to potentially be selling some of its position. Would you be interested there?
Well, we certainly are always interested in acquiring a position in attractive blocks. I can't comment on any particular opportunity. We keep those discussions confidential. But Namibia and the Orange Basin offshore there is an area that we're quite interested in and very active in.
I am curious, Mike, about the other big deal that everybody wants to know about, and that's the deal with Hess, the expansion into Guyana and those oil fields there. Where do we stand right now with regards to what you're doing internally to close that deal, and where do we stand in the arbitration with Exxon?
Yeah, Romaine. So maybe 4 points. Number one, integration planning has been ongoing since we announced the transaction, and that's gone very, very well. Number two, the proxy will be mailed to Hess shareholders before the end of April, and the shareholder vote will occur before the end of May. Number three, we got a second request from the Federal Trade Commission, and we expect to certify substantial compliance with that in just the next few weeks and be through the antitrust review process. And then that leaves the fourth work stream here, which is to work through this arbitration process relative to the terms of the joint operating agreement. That is likely to take a little bit longer. And we'll have to see how the exact scheduling plays out on that. We don't have those dates pinned down just yet.
Do you think, though, that you can get this deal done this year in 2024?
Well, that's certainly our expectation. We're working closely with Hess in order to do that. The arbitration process has been initiated, and ExxonMobil indicated in an investor conference last month that they think 5 to 6 months is what this could take. We certainly believe that's a sufficient time frame within which to clarify the specific contract provisions here. And I think Hess has actually, in their filings, indicated that they've requested a hearing in the third quarter and a decision in the fourth quarter. So that's the timing that we're working toward in a process that is still unfolding.
Mike, are you guys having parallel negotiations aside from arbitration or no?
We're always open to conversations. In fact, before the arbitration process was initiated, we had been in conversations, and Hess had been in conversations with the other members of this joint operating agreement, and in an effort to understand their concerns and to address those concerns and seek resolution. The arbitration really ended those discussions at the time, and that's the path that we're on today.
Okay, so not talking quote unquote yet, yet. Mike, internally, are there Plan B conversations? Most experts think that you guys are going to win this, but if you don't get Guyana in some capacity, what is a Plan B?
we had laid out a very strong plan before we announced the Hess transaction, increasing our free cash flow at a 10% compound annual growth rate over the next several years. We've got more resource in our portfolio today by a substantial amount than we had just a decade ago. We've outlined growth plans for the next 10 years in our investor conferences. And so we have a very strong foundation going forward. We like the Hess transaction. We think it's good for the shareholders of both companies. We think it makes our company even stronger. But it was done because it would make us a better company, and it would create a premier company to compete and reward shareholders and be positioned for the energy transition over the long haul. But we were in very good shape without that. And so this is, we've got a good, strong foundation in either scenario, but we certainly are confident that we do have, the right interpretation of this contract and expect the transaction to proceed.
That was our conversation with Mike Wirth, the CEO and chairman over at Chevron. And if you take a look at the equity price, say, over the last year, Chevron has underperformed Exxon just in the last couple months, but it has given it a run for its money. Like, it has made up a lot of what it has lost.
Yeah, and I guess I'm curious, too. I mean, I know these fights are kind of typical in corporate America, but this seems a little petty.
This one isn't very typical because of the way it's structured, right?
Yeah.
Like, if they just went and tried to buy Hess's interest in Guyana, that'd be one thing, but
Right.
buying the whole company is a little bit different, and that's why it's kind of getting bogged down in all the arbitration, and why a lot of analysts think like it will go through, but until it doesn't, could be an overhang and a big question mark / uncertainty.
All right, yeah, sure deal. All right, we continue our coverage here on The Close. I'll push ahead right now to some other earnings that we're keeping an eye on, and that is MicroStrategy. The shares have been bouncing around all day here ahead of the results after the bell. We're going to talk about more on what to expect from the software company, which is basically now Bitcoin hedge fund. That's a stock of the hour. It's coming up next here on The Close on Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. It's time now for our stock of the hour, where we're watching shares of MicroStrategy, slightly higher ahead of the firm's earnings release after the bell. Bloomberg's Jess Menton joining us for a bit more on that. And I'm sort of chuckling right now because we were having a great conversation off camera about kind of the evolution of this company. I mean, this used to be a pure play software company.
Yeah.
Now it's pretty much, for a lot of all intents and purposes, kind of more of a pure play to a certain extent in the crypto space. This has basically become a Bitcoin hedge fund.
Basically,
Yeah.
So this was known, to your point, Romaine, as an enterprise software company. So back in 2020, so Michael Saylor, the CEO of MicroStrategy, they actually started investing into Bitcoin, and really he did that as a hedge to be what was going to happen potentially with inflation. So when you look at that bet, and especially over the last 4 years or so, if you're looking and seeing how much money he ended up making off of that, we actually had a great story in the Terminal that looked at this. Tom Cantiliano was one of the reporters on this. And so basically the amount of money, around $400 million so far, that they've been able to make on just this year, when you think about that, stock's been up about 100%, and then also over 300% since actually 2023. But the big question, when you do have the spot Bitcoin ETF approval in recent months, what this really means for this company moving forward,
And
how
just
that
to be clear,
impacts
that
it.
money doesn't really flow to the income statement
No.
because he's not really selling it.
No,
right?
that's
so it's
correct.
kind of unrealized.
So
gain.
those also don't include the paper profits that he's
Right.
made
Yeah,
off of this
exactly.
either.
Yeah.
So that's only just one sort of lens through what that is going. But then also, if you look at SERP, so the implied volatility move for this particular stock, it's actually relatively muted to how it's been over the last 2 years. So right now, if you look at that, the potential swing in either direction after the closing bell, once we get the report, it's actually around around 2%, but if you look over the past 8 quarters, it's actually been closer to 6%. So it's going to be interesting to see what exactly plays out. And then obviously on the earnings call and what we hear from Saylor.
So now that I know we're talking about this stock and not Supermicro, which that's really why Romain was asking before. I was like, what? That's a software company. But what does it trade as a, like, who's going to be buying it for and for what reason?
Yeah, so that's the million-dollar question moving forward, because also Romain was talking about this earlier too when it comes to sort of your exposure toward that and being a proxy. So a lot of people really were moving this because especially when you look at Bitcoin up close to around 50% this year, and then also Bitcoin's been up close to around 300% over the past year as well. So if you're trying to look for that exposure, that's where other investors were looking to. The caveat is just with the spot Bitcoin ETF approvals from earlier this year and sort of the correlation between how those stocks have performed relative to Bitcoin has been closely as tied just in recent months because all of that's been happening. But people want to know more from those calls exactly what their kind of future plans are as this all begins to roll out.
Makes much more sense.
It does.
It does. Versus the conversation we're having in break, and I'm like, this doesn't make sense to me, guys. All right, Jess, thanks a lot. Really appreciate it. Jess Menton setting me all straight here on Bloomberg Television. The stock is down by about 0.5%. It has had quite a run. It has had quite a fall also as well. All right, coming up, we're going to count you down to the closing bells. Anwiti Bahuguna, a CIO of Global Asset Allocation over at Northern Trust Asset Management, will be joining us. And I'm looking at a market here. I gotta say, it's not doing anything. And you have to wonder, Romain, is it gonna be earnings? Is it gonna be jobs? Is it going to be the Fed? We get all three this week. What is gonna be that mover?
I think it's gonna be all of the above, but of course we had that conversation with Ian Lyngen. He talked a lot about this idea that the jobs report is really gonna drive the day.
Yep.
But the earnings are important too, right? Like I said, you mentioned Google. You mentioned, I'm sorry, not Google. Who do we have? Amazon this week. Apple this week, and a big one tomorrow after the bell. Supermicro scheduled to report.
Oh, excellent. And I have that preview all ready to go.
This is the close on Bloomberg. This is the countdown to the close. Romain Bostic alongside Alex Steele. 10 minutes, Alex, until we get to those closing bells. And, well, the price action, not a whole lot going on, but I guess it's green, so that's an extension of the gains that we saw from last week.
Yeah, it is a little disappointing, though, because there's not that much movement here. But you do have communication services lower. You have the worst performing stock within the S&P. Say the second worst performing stock is Alphabet. Tesla, obviously, outperforming there. But I feel like this sets us up for a sort of dicey scenario into Amazon tomorrow and then Apple on Thursday when you have members of the FANG, Mag 7, yada, yada, not doing as well.
Yeah, absolutely. That's obviously been the big driver of this market, those corporate fundamentals, and we'll see if that story changes at all when we get those big tech earnings. Of course, we're also getting a lot of economic data as well, but we had a chance to catch up with Ian Lyngen, head of U.S. rate strategy over at BMO Capital Markets, and we actually asked him why he's actually more focused on Friday's jobs report rather than anything else. Take a listen.
Well, I do think that we know a lot about what we're going to hear from the Fed. We know a lot about what Yellen can and can't do in terms of the Treasury refunding. And the only potential real surprise is if Powell were to suggest that the Fed's reaction function to the realized data has changed. And we just don't see that happening. So we're back in data watching mode, which really means it comes down to where do payrolls print and what do average hourly earnings look like for the month of April.
All right, Ian Lyngen there over at BMO, helping to kick us off to the close just about an hour ago. And here to help us go to the close and those closing bells is Anwiti Bahuguna, CIO for Global Asset Allocation and Northern Trust Asset Management out there in Chicago. And Witty, I do want to start off here with that jobs report on Friday, because that really is going to feed in to what the Fed does next. And I know one report does not necessarily make a trend here, but are you concerned at all that all of those expectations that this would be the year where the Fed had the ability to cut rates, that might be long gone right now?
Hi, Romain. Thanks for having me. I think job reports is indeed the key report to watch this week. I agree with Ian that we shouldn't be seeing dramatic changes in the Fed's reaction function. The one thing I would add is what I'm looking for in the jobs report is really the wage inflation data. I think what surprised me last week was market narrative around growth weakening, but inflation being strong. And I didn't quite see it this way, Romain. I saw growth actually remaining very strong with personal consumption spending coming in at 3%. And inflation data stickier this first quarter, but beginning to come down at a very slow pace. So I would look at the jobs report to again see those dynamics show up,
right,
where growth remains strong and we begin to see some improvement in the wage inflation data coming down slowly, but definitely in the right direction.
Well, let me play devil's advocate here. Right now, economists expect the unemployment rate at 3.8%. That's holding below 4%, where it's been stuck for quite some time. We had a GDP report, I think, last week that showed a slowdown in growth below 2%. And of course, now we're seeing a lot of reports, whether it's PCE or CPI, that shows persistent inflation. Based on the classic definition of stagflation, Anwiti, and I'm sure you know this, some people would say that that is the recipe, that's the cocktail where we're headed right now. Do you believe that?
Yeah, I would disagree strongly with that view, Romain. I think the 1.6% headline number on growth is extremely misleading. If you look through the details of that number, personal spending is around 3%. Business investment's fairly strong. The thing that brought that number down was really the volatility in the trade details and inventories. Both of those are really hard to predict, but the core of the US economy is actually performing well above 2%. And so to me, this is by no means a stagnant growth environment. The thing that I will agree with you, Romain, is that inflation needs to show some more improvement. And so far this quarter, it just hasn't. It's stuck at around that 4% number. And the month-over-month numbers are not going in the right direction. And that's why the wage data is important, because that's a key component of that services inflation that we look at.
It also really highlights, though, how good earnings have been. I think, 81% of S&P firms have beaten first quarter profit estimates. And I can imagine, okay, so maybe you overpredict and underpredict and overdeliver, sure. But when you have an Amazon and an Apple reporting this week as well, what is your take on how to play big tech in this environment?
So we don't actually make sector calls, Alex, but if you look at broader earnings data, the growth numbers are expected to be around 3%. And what I like to look at is the breadth of earnings. Are we seeing earnings beyond big techs? And Alex, we're not seeing that this year. It's still very much in the first quarter, all about really strong earnings coming from the big tech, coming from those names, but nothing in the broader range of the sectors that we have in the S&P 500. And also looking beyond S&P 500 into smaller cap stocks, into stocks abroad, we're not seeing improvement in breadth. It's still very much a growth index dominated environment where value continues to underperform growth.
So based on that, what should be the best asset allocation in this environment?
So I hate to say this, but we're very, very, very neutral across all the major asset classes. We don't have a strong lean on any one major tier one asset class, as we call it. So we're neutral stocks versus bonds versus real assets and other asset classes that one might invest in. In other words, we're advising clients to stay close to their strategic allocation. The only one area where we have taken a strong position is in credit, where we are overweight high yield bonds, because in this reasonably strong growth environment, default rates are likely to remain low, and the yield pickup you get from high yield right now is just very attractive.
All right, Anwiti, always great to talk to you. Going to have to leave it there as we get closer to the closing bells. Anwiti Bahuguna, CIO for Global Asset Allocation over at Northern Trust Asset Management. And Alex, this does seem to be a market that's kind of taking things in stride with 3 minutes until the bells. Stocks higher. I thought it was also interesting, too, that when you look at what's going on in the debt markets, there was a lot of expectations that the Treasury was going to hold still with that refunding. Mm-hmm. They boosted that refunding, and you didn't really see a huge reaction in the market. They seem to be taking it in stride.
Yeah, and I wonder if that's because they're expecting the Treasury to issue in bills, which demand should be sopped up versus anywhere else on the curve. But you're right, and that the 10-year is just down by 4 basis points. I wouldn't expect that once that headline crossed the top of the hour.
Yeah, and it was already down, I think, maybe like 3 basis points or so before that announcement came out here. So it gets to this idea that while investors, to a certain extent, they're always worried, but this idea here that things really aren't that bad and they can at least make money in this environment, maybe not in the most attractive areas, but you can find it, right?
And that Liz Truss moment when everyone's going to freak out and bomb Giuliani's are going to have their day in the sun.
Liz Truss moment. I completely forgot about it.
Exactly.
All right, we are moving closer to the closing bell. Stick with us. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with, well, the entire family finally back as one. Scarlet Fu joining us in the TV studio. Tim Stenovic and, oh my gosh, you telling me Carol Massar has the day off once again? So Emily Grafale, a very capable Emily Grafale, filling in for the ever vacationing Carol Massar. Welcome to our audiences across our Bloomberg platforms. Tim, what do you got?
I got a big week. I mean, we got Apple earnings on Thursday. We got Amazon tomorrow. We got the Fed kicking off its two-day meeting tomorrow. We got April employment figures coming on Friday. I mean, we got a big week, Emily.
And we still have earnings as well. We have Apple coming up and Amazon as well and some smaller names. But of course, you got to focus on the macro, like you said, Tim, the Fed, Jobs Day. It is a very big week.
A very big week in which we see spreads narrowing, and you see a company like Boeing able to attract almost 8 times the amount of bonds that it has on offer, easily selling $10 billion of corporate bonds.
What's interesting, though, as I mentioned this earlier, is that 81% of S&P 500 firms have beaten first quarter profit estimates so far. That's a really big number. But the stock price hasn't really outperformed even if you have beaten. Of course, that's a Mike Wilson over at Morgan Stanley, just being a little bit of cold water on any kind of rally that we're going to see.
Yeah, he has a lot of cold water. I think his faucet only has one temperature.
He doesn't like rates at these levels.
But in fairness to Mike, too, because, I mean, there's a good point, though, too, because he was, you look at the revenue growth and the revenue beats, I should say, not as strong as the bottom line beats. And more importantly, when you look at the guidance that these companies have given, a lot of that has come in a little shorter than what folks were expecting. Let's walk you through the numbers here on this Monday afternoon. Modest gains across the board for the major indices here in the U.S., with the S&P 500 up about 16 points or 0.3%. A similar percentage move right out there for the NASDAQ Composite, also up 0.3%, while the Dow Jones Industrial Average is going to move higher by more than 140 points or 0.4%. And the Russell, Tim, that's your outperformer, up 0.7%.
All right. Well, we're getting some news that Paramount Global is announcing new leadership changes. CEO Bob Bakish stepping down from his role as CEO. Not a surprise to those who've been following over the last few days. Again, Paramount Global just out with a press release saying that global CEO Bob Bakish stepping down.
Yeah, apparently he and Shari Redstone were not seeing eye to eye. There are a lot of offers made for different parts of Paramount that he at different points rejected. And as a result, they are not going with any one CEO as his replacement. They're establishing an office of CEO, which does that inspire confidence when the company is trying to sell
I don't even know
itself?
what that means.
Well, I mean, but look at who it is. I mean, no, it doesn't inspire confidence to answer your question. Though I will say this. I mean, when you look at who it is, you're basically talking about Greg Cheeks, who was running CBS. You're talking about Chris McCarthy, who was running the Showtime and MTV networks. And then they're bringing in Brian Robbins, who was, I guess, heading up Nickelodeon and some of the kids' programming here. So it's kind of a cross-section of all the major broadcast properties there. So maybe that provides some confidence that the people running this company now are probably more on the content side rather than, just on sort of the financial side.
But what does it mean for the future of Paramount Global as a standalone public company?
It means it's going to be sold, and sold soon.
That's where I'm going with this. So Shari Redstone, chair of the board, saying that Paramount Global includes exceptional assets that we believe strongly in the future value creation potential of the company. The question is, where does that value come from? Does it come from a new ownership, or does it come from staying independent?
Well, that's the other thing, too. I mean, we talk about, to Scarlett's point, whether this is a good idea to have basically 3 CEOs thing. But, let's face it, this isn't going to last long one way or the other. If this is sold, they're going to have to find some different management structure. And so this seems to be much more of a stopgap.
End of an era, though, for Bob Bakish, right? He's been at Viacom since 1997.
Yeah.
He was CEO of Viacom back in 2016, CEO of the combined company back in 2019.
Yeah, and one reason why he was able to rise and stay in his position was because he did get along with Shari Redstone once upon a time, a long time ago. That is no longer the case, and this is definitely a company, Romaine, as you were putting it, set up to be sold. The question is whether it will be Skydance that is the actual acquirer, and of course that's the Redstone family's preference, or Apollo and Sony, or maybe there might even be another dark horse candidate coming in here.
I do find it interesting if you just look at the three that are taking over, and you guys pointed this out, but it's worth spending some time on it as we're also waiting for the numbers to come out. Is you have Chris McCarthy, President and CEO of Showtime and MTV Entertainment Studios. You have the Showtime studio part. Then Brian Robbins is the president and CEO of Paramount Pictures. Then you have the movie behemoth. And then you wind up having George Cheeks, who's the CEO he'll be the CEO over at CBS. So, and that's sort of the trifecta of what Paramount Global actually is. And I wonder how that sets up each of its areas to either be sold separately or then tried to together.
Yeah, and I mean, and that's the big question, though, and a lot of questions about what the new structure would look like, whether this would be sort of a white knight coming in and buying the whole thing, or whether they're actually just looking for certain pieces of it. And I think, guys, if you're keeping an eye on the wire right now, I think we're actually finally getting the numbers for the most recent quarter, and they're pretty much what you would expect it. A miss on several of the key metrics. I'll just give you the top and bottom line here. 1Q revenue coming in at $7.7 billion. The street was looking for about 7.74, and as far as the loss per share, at least on a continuing basis, looking at about 88 cents here. Not sure of the comparison, but when you look at the 1Q adjusted EPS for continuing ops, they did beat there, 62 cents at 36 cents, so I'm not sure these numbers actually matter anymore.
Yeah, shares bouncing around a little bit, but still higher in the after hours by a little over 2%. First quarter direct-to-consumer revenue coming in right at estimates of $1.88 billion. First quarter TV revenue at $5.23 billion, missing estimates of $5.33. But Scarlett, like Romaine said, the big question is, do these numbers even matter?
Do the numbers really matter? Well, if you're a potential bidder, they do, because the filmed entertainment revenue was actually one part of the business that beat analyst estimates. $605 million. The consensus estimate was for $577. And again, if you're Skydance, this really matters, because this is what their whole thing is, right? Skydance is making movies, and Paramount has this storied franchise, and that's what they would be buying.
Yep. Interesting, in the earnings release, the statement is from Naveen Chopra, the executive vice president and CFO, so not even Bob Bakish there, just saying that the team delivered a strong operational and financial performance despite a, quote, dynamic environment we continue to operate in. Code, that's code.
Wow, what a euphemism.
For hot mess.
Hey, there are other companies out there reporting earnings. MicroStrategy, technology company that's really a levered Bitcoin play, is announcing its first quarter results. It has now 214,400 Bitcoin. First quarter loss per share at $3.09 versus estimates of $31.79. The first quarter revenue did miss estimates. Again, another question of to what extent these numbers matter, considering that people who buy into MicroStrategy are essentially buying this, levered Bitcoin play.
Yeah, are we surprised that the stock isn't moving more? Just either way, like doesn't the stock tend to move whippily with results?
Moves with Bitcoin. That's what it seems like.
I like the way you put that, though. A levered play on Bitcoin. I mean, what's the difference between buying MicroStrategy versus an ETF at this point?
Well, that's the problem.
Yeah, well, it's funny though. I feel like a lot of the volatility in the stock comes not around earnings season. We had Jess Menton on earlier. She said the implied move just for this earnings period was supposed to be like 2 to 3%, but she said even in past periods it was only like 6%, which is like well below what you see for like a Netflix or a Tesla or something like that. All right, let's go back to Paramount, guys. Those shares are still moving higher here as we continue to get numbers here about the performance. I think it's interesting. We talk about Paramount Plus, the big streaming service, and let's face it, I think some of the shortcomings there are a big part of the reason why we're talking about a sale. 71 million subscribers there. That's higher than what the street was looking for, but of course, that's just a shadow of what Netflix has, or over 300 million.
You know, when we think big picture about the companies here that are competing in this space, the Disneys, the Hulus, which of course is Disney, and the HBO Maxes out there, all competing with what Netflix has essentially been the only company to really succeed at. I wonder what consolidation looks like down the road here for these direct-to-consumer players, especially as a company like Skydance is so interested in the movie studio and what it ends up doing with the direct-to-consumer model if this ends up happening.
So just to recap here, Paramount Global out, CEO Bob Bakish stepping down, the company putting in place an office of the CEO, 3 divisional heads. You have the CBS, you have Showtime, and then you have Paramount Networks. All of that coming in. Some of the numbers, though, not terrible. Entertainment revenue beat estimates. Direct-to-consumer revenue also beat estimates.
And on that point, Alex, too, I mean, I was just looking through the numbers that were specific to Paramount Plus, the streaming service, as I was denigrating their only 71 million subscribers here. But the revenue there is phenomenal, actually. 22, at least on a growth basis, 22% subscription revenue growth, 31% ad revenue growth. Though they do say a lot of that was benefiting from having the Super Bowl this year. But overall, ARPU average revenue per user, up 51% on a year-over-year basis. I can't remember what those numbers were like for Disney Plus and for Netflix, but I know they weren't anywhere close to that.
So you bring up the Super Bowl, and of course that's going to boost the numbers, but at the same time, that costs a lot for CBS, Paramount to pay for those rights. Tim, you were saying what happens next if, in terms of all these different streaming players, they end up bundling all the services once again.
Wait,
right?
a bundle?
Yes.
Hold on.
We went from bundling to a la carte. We're going to go back to bundling again.
I'll tell you that I'm paying more for each of these subscription services on their own at this point than I was.
Emily, do you subscribe to Paramount Plus?
I do.
I don't.
You don't?
This is just like a return to cable. That's what's going to happen.
I do. Survivor, dude. I'm all about Survivor. That's my jam.
I subscribe to all of these.
I'm trying to get my husband to go on it, so we're all in on that. That's the only reason why we have Paramount Plus.
All right, I'm going to get on that train, Alex. That sounds great. Cool. Hey, that is going to do it for our cross-platform coverage of Beyond the Bell, though keep it here for all the updates happening when it comes to Paramount and all the other earnings. That is going to do it for our cross-platform coverage. Catch us same time, same place tomorrow, guys.
And our coverage continues right here on Bloomberg Television. Paramount out with results just a moment ago here. The top and bottom line numbers, a little bit of a mixed bag. Revenue relatively in line with estimates, a slight beat here on an adjusted EPS basis. But of course, the big news is that Bob Bakish out as CEO as Sherry Redstone and her family try to execute a sale of the company. Geetha Raghunathan joining us right now, Bloomberg Intelligence's U.S. media analyst. All right, Geetha, let's get right to it here. Let's put aside the numbers for a second. The general scuttlebutt out there was that one of the biggest impediments to getting the deal done was Bob Bakish himself. Removing him, does that change things?
It definitely does change things, Romain. So now they obviously have the interim triumvirate, if you will, of the three section heads. And this is, again, as you just pointed out, it's just a stopgap. Ultimately, what we're going to look at if the Ellison-Skydance Media deal goes through is David Ellison kind of taking over as CEO, and then the former NBC chief, Jeff Shell, taking over as president. So that's kind of the ultimate leadership structure. This is just kind of an interim arrangement here.
Okay, it's an interim arrangement, and I know we say the numbers don't matter all that much, but if you're Skydance and you're looking at these numbers, does this make Paramount more attractive to you or less attractive given the numbers we see? Filmed entertainment revenue, $605 million, beating analyst estimates, but TV revenue, $5.23 billion, missing the average analyst estimate.
The numbers on the whole, Scarlett, are definitely okay. I mean, they're almost slightly better than what we were expecting. The one number that I was kind of looking at was the direct-to-consumer segment. And we were looking here not just at the growth in subscribers, which came in well above estimates at almost 4 million subscribers added in the quarter, but we're also looking at streaming losses. Remember, the new mantra across the media landscape is really profitability. Again, they're not profitable yet at this point, but we were expecting higher losses that came in below 300 million. So that would definitely is a slight positive. And then you had advertising revenue. Of course, you could argue that was a boost from the Super Bowl, but overall, I think the results look pretty decent.
The results look pretty decent. When you think about the new CEO office that they have, these three people who are splitting up the big role, does that give indication that we're going to see a breakup of Paramount into different assets and Skydance or whoever else comes along, whether it's Apollo and Sony or someone else, are going to buy bits and pieces as opposed to buying the whole thing?
So the whole Skydance pitch has been that, first of all, they're going to continue to trade as a public company, with the merger of Skydance into Paramount. And that's exactly what Sherry Redstone kind of wanted. She didn't want, the kind of a yard sale of all the different parts of the company. So with Skydance, I think they will try to keep the entire structure together. Of course, with Apollo and Sony, it's going to be a completely different situation. We know that Sony really is only interested in the content production arm, which is, the TV and the film studio. And of course, Apollo already owns quite a few TV stations. So it would kind of make sense. And Sony can't own them again because of, a foreign ownership with broadcast assets. So again, CBS and some of the stations kind of would go to Apollo. So it's, sorry.
Well, I'm curious, Geetha, though, what is kind of the identity of this company now? Because whenever everyone talks about the value of Paramount and particularly CBS and some of their other properties here, I always hear them referring to kind of almost legacy things, right? I mean, there's no doubt about it. They have a great catalog and have some great licensing. But at the end of the day here, are they producing newer content to the same extent that maybe we're seeing out of Netflix or Disney?
definitely are producing new content, Romain. We are seeing that. And a lot of the success on their Paramount Plus streaming platform is actually because of all this content that they're producing, whether it's kind of the Taylor Sheridan universe, whether it's, new Star Trek series. They're having quite a good, success rate with that. The question, though, is, and this has kind of been this constant criticism of Bob Bakish as well, is whether they should have even ever made that pivot to streaming in the first place. Because yes, they do have 71 million subscribers. That's not bad at all, but it's come at a big price. They've lost rather $5 billion to date on that service, and they're only going to lose more and more. There's always questions about whether it's going to turn profitable ever.
But how do you do that? Because I feel like Netflix is going through the same thing, and as I'm sure you know, they've made a big change in their filmmaking strategy, kind of putting a little bit more focus on very specific things. I assume in a way to control those costs here. Would something like that benefit Paramount?
It's going to take a long, long time, Romain. So obviously we know the whole Netflix story. Yes, they were facing a very similar situation, but they have that kind of first mover advantage. So now you're seeing a lot of operating leverage in their model. And with 270 million subscribers, they can spread those costs, obviously, and extract a lot of value. Paramount, unfortunately, cannot do that. You're spending the same amount of money to create a piece of content, whether you have, 5 people watching at 70 million or 270 million. So obviously, scale matters in this business. That's what all of these companies are learning. And it's going to take a long time for the Paramount Plus streaming business to really turn around and be profitable.
All right, Geeta Raghunathan over at Bloomberg Intelligence. A nice breakdown of what we heard out of Paramount. Those shares higher in after-hours trading, only by about a couple of percent or so here. Again, you're still talking about a company, for all its troubles, generating $8 billion in revenue in the most recent quarter, about $3 billion of that coming through advertising. But the big headline is Bob Bakish, the longtime CEO over there, is out. Scarlett.
Yeah, I like the way you put that, though. As much as we talk about how this is a company in trouble, it still makes a lot of money. It's just slowly deteriorating, and we know the trajectory. We know that it's going downhill, so they need to do something, but they've wasted a lot of time, it feels like, trying to figure out what that thing is.
Well, I think having Bakish out, maybe that speeds things up,
Yeah,
maybe. And right now you got 3 CEOs. It'll be interesting to see how they share that. But I do think it's interesting that all 3 of those folks are basically content folks.
Yes. They are there to hold the ship tight, keep things in order until something gets done.
All right, we're going to keep an eye on this story. We'll get back to it a little bit later, but coming up after the break, we're going to have a broader conversation about a lot of changes going on in the world and what's wrong, or at least what went wrong with capitalism. That's the title of an upcoming book by the chair of Rockefeller International, Ruchir Sharma. It's coming up next, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
You've been off for a few days, Scarlett. Did you forget your line?
I'm so excited to be back, I just couldn't speak.
All right, well, maybe that's fitting. I'm Romain Bosico, by the way. I forgot my line. But maybe that's kind of fitting because it was kind of a mad day in markets here. Not a whole lot to talk about. The S&P 500 finishing the day higher, but only by about 0.3%. Similar gains for most of the major indices here as the market's in a little bit of a holding pattern, awaiting some big earnings, awaiting some big economic data, and of course, a big Fed meeting where they've really got to telegraph what they might do next. One of the few bright spots out there was the NASDAQ Biotech Index here. Biotech stocks having a pretty good run as of late. Bitcoin not doing much of anything. And of course, the talk of the town this morning and of course, over the night was all about the yen. Dollar yen at 160 at one point, back around 156 today.
And we'll dig in a little bit more to what's going on in the currency markets, but I want to tell you about some individual corporate movers here. We're going to start with Boeing because one of the year's worst performers in the Dow Industrials is the best performer today in the Dow Industrials, up 3.75% to just over $173. This is after its $10 billion bond offering generated a ton of demand, about $77 billion in orders. So that's almost 8 times. Boeing, of course, raising funds to refinance some of its debt and to ease its cash burden just days after reporting a quarterly loss and also almost $4 billion in cash burn. And this comes as the company's credit rating is just one level above junk status. We also have SoFi Technologies. This is the online lender, the online bank. It gave a forecast for this quarter, both revenue and bottom line, that missed some analyst estimates. So that stock losing about 10.5% today. But as we're talking about dollar yen, our top story this hour, Japan's currency actually holding on to its gains after mounting a furious comeback following a slide to a 34-year low. The manic moves resulted in the busiest trading day this year for the yen. That's according to the CME. The question now is not so much whether the government came in to support the yen, but whether this is an actual true turning point, especially since traders continue to position for further weakness down the road. Romain?
All right, we're going to get back to that story in a second. We do have some breaking news, Scarlett. This involving Hess and Chevron. Chevron, of course, bidding to buy Hess. We're now learning that Hess is saying that the SEC here in the U.S. has finished its review of the proposed Chevron merger. This coming in, a proxy filing just coming out just a little while ago. The company, though, is saying that it is still working with the FTC, one of the other regulators, on a request for info. And, of course, there's still the big question about some of the legal claims that rival Exxon, is making to block that deal. We talked with Mike Wirth, the CEO of Chevron, earlier today, and he does say that he expects the Exxon arbitration to be resolved in the coming months. So maybe some movement there on that Chevron-Hess deal. We'll keep an eye on that, but we do want to go back to the global story, as Scarlett was just setting up, and do so with who better? Ruchir Sharma joining us right now, founder and CIO of Breakout Capital and the chairman of Rockefeller International. Ruchir also has a new book that's going to be coming out in June entitled What Went Wrong with Capitalism. Ruchir, great to have you here on the program.
Thank you.
Well, let's just start with your upcoming book here, because that's a pretty, heavy question, because I guess some people would say, what went wrong with capitalism? They would say, well, everything, right? But that has kind of been the undercurrent for so much of the geopolitical rifts we've seen over the last decade, maybe even more than that, whether it's the way people vote or the policies that countries are taking against one another. A lot of that is tied to this idea that the capitalism born out of the post-war 50s and 60s, et cetera, some people think that is fundamentally broken.
Yeah, exactly.
Yeah.
But the point I make in the book is this, which is the fact that the capitalism we have today is a very distorted form of capitalism compared to what the founders had in mind. Mm-hmm. The tagline of the book is that capitalism did not fail, it was ruined. What ruined it? Which is that risk has been socialized, that the involvement of government has expanded incredibly, and not just in terms of the government's involvement as a share of the economy, which has gone up. It used to be 3% like a century ago. Now the government's share of the economy in places like the US is approaching 40%, right? So that's gone up significantly. But it's also the role of the government. Look at the regulatory state. Look at the number of bailouts. In places like America, in the 1950s and 60s that you referred to, it was unheard of to bail out any company. The first big bank bailout in America happened in 1984. In the 1970s, there was the odd other corporate bailout, but there was so much protest from Congress around it. Now, bailouts seem to have become the norm. Nothing is too small to fail. So I think that so what's happened is that risk has become socialized.
Right.
And as a result of that, you're getting many distortions, which is that capitalism today has become very pro-incumbent, very pro-big business, and a lot of the mid-sized businesses and a lot of people are feeling the effects of this, that the data shows there's lack of social mobility, lack of economic mobility, too much concentration of power.
Right.
So it's some of these issues that I address in the book today, that how did we get here and how different capitalism has become from what it was a few decades ago.
But how do we address that? Because as you sure you know, I mean, there were a lot of grievances here in the U.S. over those issues, that capitalism didn't work, at least for certain generations, and that's why you saw the rise of Trump. You saw similar populist movements in the Middle East, in Asia, India, even in Latin America here. A lot of people, meaning rank and file voters out there, they're looking at that current world order, at least the world order of the past few decades, and they're saying it's not working for us.
Yeah, but it's so interesting. My country of origin is India. I came from there. I grew up at a time when socialism was the norm in India. I've seen what socialism does, which is what it leads to: mass poverty, and in terms of completely curbs individual freedom. So I came from that background. I know what socialism is. But what I'm trying to say here is that the capitalism that you have in America, the typical capitalism should be pro-competition, should be pro-churn, that you should have new companies come up all the time, new competition come. But in America, what we have seen, and this is true much of Western capitalism, is instead a tendency towards increased concentration. And because of that, you have so many towns which are dominated by just one company. So the worker feels almost bullied by that one company.
Right, and if that company picks up and moves, then the town is devastated.
The town is devastated, but even the bargaining power, the workers don't have much bargaining power when you have one town dominated by one company. So I think that what I try and show here is that concentration is not the norm of capitalism, and neither is the fact that
the incumbent or whoever's in power in terms of corporates remain in power for so long. And the other data which I haven't spoken about, the number of zombies today in America, that nearly 1 out of every 5 companies in America today can be classified as a zombie company. That number used to be 2% as recently as 1990. But now you have the zombification of America in some way as well. So you got this very uneven thing. You got zombies at the bottom propping up, and at the top, you got this incredible concentration of a few companies, and it's led to the hollowing out of a lot of other companies in the middle.
Okay, I hear your point, but if you look at how the U.S. economy is doing right now, it's holding up pretty well, and we're not getting a hard landing. We might not even get a soft landing. We might just get no landing right now. And one of your points is that what's driven the economy and what's really supported its strength is the extent of fiscal stimulus that people don't appreciate has gone beyond what just came right after the 2020 recession. What is the most underappreciated part of that fiscal stimulus you see that is having a pernicious effect on what we see in the economy?
Yeah, so this is where America has been exceptional in not a great way, which is that if you look at all the other economies in the world, they all did massive stimulus during the pandemic, and so did America. But those countries, after the pandemic sort of wound down by 2021, scaled back on the stimulus. In America's case, the big difference was that they kept on doing more stimulus through lots of other things, the CHIPS Act, the IRA, or other tax credits which kept going out. So the stimulus carried on. So even last year, in 2023, fiscal stimulus alone is supposed to have contributed at least 1 percentage point extra to America's growth. Now, the problem is this, which is that, fine, you've done that, and it all looks good at the surface for now. But because of that, America today is running a fiscal deficit, which is well above any other developed country. It's like an outlier now. And America's debt levels now are approaching those of only Japan and Italy out there. So these are very sort of different trends. And now, people tell me that, but America looks good now. Remember, a decade ago, the economy, which looked very good because of stimulus and was the talk of the global economy and seemed to have saved the world from a global recession, was China.
So very quickly, Ruchir, what's going to be the tipping point? What's going to tip us into that point where everyone recognizes, hold on, there's a lot of fragility here?
I think it's that the next crisis has to be a fiscal crisis. That's when it'll come, which is that as interest rates keep going up and in terms of that the financing becomes more difficult, I think that's what's going to be the tipping point, because currently everyone assumes that because America has the dollar, it'll be able to fund its massive deficits for a long time to come. At some point in time, that's going to turn around and people are going to be saying, hey, we can't fund this deficit because it's just too large. And interest rates are going to keep remaining higher for much longer than what people have anticipated today.
All right, Ruchir, we have to leave it there. Great to talk to you. Ruchir Sharma there of Breakout Capital and Rockefeller International, the author of several books, including Breakout Nations, as well as The Rise and Fall of Nations, a new book coming out in June called What Went Wrong with Capitalism. Stick with us. This is Bloomberg. All right, time for this day in history and a look back at April 29th, 1939. That's when the National Broadcasting Company brought television to the world. Now, to understand why, we have to start with NBC's origins as a radio network 13 years earlier in 1926. That's when the Radio Corporation of America, better known as RCA, realized that the best way to sell radios was to make sure there was plenty of content for people to listen to. RCA partnered with GE and Westinghouse Electric to buy broadcast assets and launch the first permanent radio network in the country. Now, it was that same impetus of selling consumer electronics, along with the profits from NBC's radio business, that led RCA to push into technology and content for the television. NBC used the opening of the 1939 World's Fair in Queens, New York, to unveil its new technology, a short TV broadcast, very short, where RCA chief David Sarnoff gave a dedication of the RCA pavilion at the fairgrounds. A day later, NBC Television began regularly scheduled broadcasts, and that included a speech by FDR. As big of a milestone as it was, no one actually watched it. They couldn't. NBC Television had only one station at the time in New York City, an area that at the time was estimated to have fewer than 1,000 TVs, most of which were in public spaces like bars and exhibition halls. But household adoption of the TV, it was about to take off. The FCC in 1941 authorized commercial broadcasting, which let TV networks run paid advertisements. The first ad ever, it was a 10-second commercial for Bulova watches that NBC charged $7 to run. The number of television sets steadily rose from fewer than 10,000 in the mid-1940s to more than 10 million by the early 1950s. And by the end of that decade, more than half of U.S. households owned at least one. It's estimated that no new invention entered U.S. homes faster. Today, of the more than 125 million households in the U.S., about 96% of them have a television. And that brings us to our question of the day. For all the content NBC aired over the past century, from Howdy Doody to I Dream of Jeannie to Cheers, what show has lasted more than any other? The answer, the Sunday morning talk show Meet the Press. It made its debut back in 1947 and remains on air 77 years later. That's a longer run than any other show on any other broadcast network. That includes The Tonight Show. It includes Face the Nation. It even includes the soap opera Guiding Light, which are all age-wise still only in their 60s.
Great summary there. And sounds like they're all boomers when it comes down to it. Romain, that is a great segue into recapping those results from Paramount and the broader media landscape. Joining us now is Michael Wolff. He is founder and CEO of Activate, a management consulting firm that specializes in media and technology. And Michael, we just heard at the top of the hour that Paramount reported results. Its first quarter earnings beat analyst estimates. Sales did miss, but ad sales overall increased, and losses at Paramount Plus, its direct-to-consumer streaming service, narrowed, with customers topping 71 million. So those are numbers that should find some comfort with investors. But at the same time, the company announced that it is replacing its CEO, Bob Bakish. He's leaving the company with a trio of managers of each of their different divisions. Let's talk about Paramount as a company right now, because when you take a step back, you're of the mind that the company has done a lot of good things under Bob Bakish, who is being forced out right now.
Right. I mean, there are a lot
surprising.
there are a lot of people who are second guessing. They're second guessing, should the company have invested in Paramount Plus instead of just being a seller of programming? And there's a lot that's under the surface here that people don't realize. One of them is Pluto. Pluto is the free streaming service, and it competes only against Tubi, which is owned by Fox. Both of them globally are hitting up against 100 million users. And it's not even clear. So here we are in a moment where M&A is dominating the discussion around the company. And we've got Sherry Redstone doing her own deal, and at the same time with Redbird and with Skydance. And on the other side, you've got Apollo, which is making a $29 million offer for a company that has roughly a $20 billion market cap. I'm sorry, $20 billion enterprise value.
So when you look at these different offers, how do you evaluate which of them would be better for shareholders versus, say, the film and entertainment industry at large?
I mean, it's not clear which is going to be better for shareholders. And so this is still in flux. Skydance has said they're going to put in another $2 billion. And so it just comes down to what are the economics in terms of how many of the shareholders are going to stay into the deal? Will Sherry Redstone sell her shares at a premium? For the overall entertainment business, it's important that Paramount remain a strong company. And the last thing we want to see is a company, another streaming service that go under. Maybe it'll merge with somebody else's.
What about the general structure, though? Is it better for this company, all those media properties, to be under the same roof, or is there value to maybe splitting that up?
There's always been this conglomerate discount. And so absolutely, here you have a company with a market cap at around $10 billion plus another $10 billion of debt. Some of these assets, I mean, you mean to tell me that CBS and their stations are worth less than that? I mean, so here we are, we've got different assets, whether it's the cable networks, the studio, Paramount Plus, Pluto, and the television network.
But some of that too, I mean, some of that discount, while that's certainly the conglomerate discount as well, but some of that has been, at least the perception, that Paramount as a whole was kind of behind the curve with regards to changing viewing habits, the way we view television, the idea that the linear TV model that they banked on for so many years and decades is effectively coming to an end here. And we saw Disney kind of struggle with that, and maybe they're still struggling with it. But Paramount, it's like, I haven't seen an articulated strategy as how they get past that.
I don't know how they get past it in a world where everybody across the entertainment business, what was feeding them were cable networks. And they were heavily concentrated. But by the way, most of the other companies are also concentrated in cable. The difference is that a lot of Paramount's programming really over time was migrating to streaming.
And they're doing that. Does it help though? I mean, I know they've got at least one contract coming up, right, with one of the cable.
With Charter.
With Charter. I mean, not to speculate too much, but is there an advantage to them maybe just saying we don't need Charter?
It's hard to imagine. There's a lot of affiliate fees that are coming out of, and there's still a lot of cable homes. I mean, today we have roughly 70 million in the U.S. Our firm forecasts that we're going to be down to about 50 million, but those are still 70 to 50 million companies, and people that are paying these companies.
Yes, it's recurring revenue, and that counts for a lot, even as it's a deteriorating industry overall. I want to segue over to Amazon, which of course has its own video service, Prime Video. How much does that matter to Amazon's overall strategy, or is that a nice to have for Amazon?
Well, it's more than just a nice to have. It's one of the things that drives people to subscribe to Prime. And there's some things that are changing there. One of them is that they're now adding advertising, television-style advertising to Prime Video. They hired Krishan Bhatia, who was the president of NBC's advertising sales, and we should see a huge push. I mean, there's a lot of estimates that they can get up to about $4 billion in advertising revenue. Let's not forget, a big piece of Amazon today is advertising. It was roughly $50 billion at the end of last year. Be interesting to see how it evolves for this year.
How do they do that, though, in a balanced way? I mean, when you look at a company like Paramount, I mean, it's still only half the revenue from advertising. They get, obviously, fees, and they have a lot of other streams of revenue here. And I know Amazon as a company is a whole different animal. But when you specifically focus on Prime and the media business here, is there a strategy there that goes beyond just ads?
Well, the strategy is keeping people on Prime, is some sort of an upcharge as they add football, and they're about to make a deal, or at least it's rumored that they're going to make a deal for basketball, both at some of the pre-games and the in-season games. But they've got a built-in audience, and the thing about that audience is they don't have to pay much to acquire it.
Well, just real quickly, we're running out of time, but I am curious, do they have more an advantage, Amazon Prime, in terms of attracting sort of those deals? So you mentioned the one with the NBA. We know a lot of these sports leagues, they have deals coming up, and we know all the streaming services are vying for it. Is there one that maybe is going to be more appealing to those types of folks than the other?
Well, certainly in each of these cases, it comes down to distribution. None of the leagues are going to give all their games to any of these streaming services. But when you have competition among platforms, what you see is that owners of content always win.
All right, Michael Wolff, thank you so much for joining us. Michael, of course, is founder and CEO of Activate, giving us an analysis on Paramount's results and also a look ahead to Amazon as well. It is time now for the top three, where we take a deep dive into the folks at the center of the day's top stories. And first up is Elon Musk. The Supreme Court rejected an appeal in his Twitter sitter case, which basically leaves in place his deal with the SEC to have an in-house lawyer pre-approve all his social media posts about Tesla. So he can no longer just tweet or post when he wants, when he hasn't been able to.
Well, you say he's no longer. I thought this was funny because when I saw the decision by the Supreme Court, my first thought was, I didn't realize he still had a Twitter sitter. Is he able to just post whatever he wants now because it's not Twitter anymore? It's X, and now he can just
I think it's social media posts overall.
Okay, because he's kind of unhinged. So I don't know. Is somebody really like watching over his shoulder?
Supposedly there is.
I mean, I saw 3 tweets or X's by him just over the past 24 hours that look like, maybe he should be institutionalized.
Yeah, well, there's supposed to be someone who's doing that.
Okay, well, they're not doing a great job. All right, someone else I'm keeping an eye on is Jensen Huang, of course, has been the man of the moment for quite some time. The NVIDIA CEO had a chance to sit down with 60 Minutes last night. One of the more interesting things I thought he talked about was just the idea of AI and this, there's so much fear that AI is going to take all our jobs, going to do everything. He was making the case, look, the human condition, if you will, at least in the workplace, is going to be fine, and we'll still have plenty of jobs out there, even if AI comes to dominate.
So investors in NVIDIA don't need any reassurance from him. They're doing just fine, but everyone else that he's addressing, they're the ones who need the reassurance that the chips that are powering his chips that are powering all these AI things are going to replace them. I thought it was interesting where he says you want humans in the loop because we have good judgment. Sometimes.
Yeah, sometimes. Although I couldn't help it as he was saying that, don't worry about AI, for a guy who's selling basically chips to run AI. I was like, is this like the wolf telling you, don't worry, I won't eat you?
Exactly. Just look away, look away. The last person that I'm watching is Adam Neumann. Do you remember him?
I do remember him.
WeWork and its financial backers have turned down a bid from Adam Neumann, the ousted co-founder, to buy the company out of bankruptcy, which was always a little bit of a head turner. I had to get my head around that for a while. But apparently the deal, the lenders never even entertained an offer from Adam Neumann.
Well, yeah, and who knows what really went on behind the scenes, but based on Bloomberg reporting, as well as some reporting by competitors, there was a lot of concern as to whether he actually had the financing lined up to actually pull this off. And maybe that had more, because look, money talks, right? And at the end of the day, it doesn't matter what crazy stuff he says. If he had the money, they would have sold it.
That would have been an interesting full circle story.
It would have been, and I think it would have given us fodder to talk about for like years to come.
Absolutely. That would be like another TV show that we could stream on Netflix
like the
or
one,
Amazon.
Like ex-Twitter account I would actually follow. It's just
Adam Neumann?
His stream of consciousness, yeah. That guy.
Maybe he needs a Twitter sitter.
Yeah.
All right, let's take a look at how markets closed on the day. Take a look here, because big tech really drove a lot of the gains, and there's some wobbliness in the middle of the day, which I think people misunderstand or think is kind of meh in the end. But you did have the Treasury coming out saying that it's going to need to borrow more money than it had thought it would need to for this quarter. So as a result, we saw yields pair some of their declines, although the 10-year yield still down at 4.609%. And of course, I bring up the Magnificent Seven, Romain, because we've got two big Mag 7 companies reporting results this week.
Yeah, it'll be interesting to see what they have to say. Of course, Amazon on tap in just a second. And then, of course, we get Apple, I think was on Thursday night here. So that'll kind of round out the Mag 7. And I mean, we kind of know Apple's going to be bad. So I don't know, maybe if that's already priced in.
Maybe they'll increase their dividend.
Yeah, maybe. And Amazon, I mean, I don't know. It's like, I feel like they always find a way to kind of surprise to the upside. So it'll be interesting to see how investors take that.
They have a lot of levers to pull, like you say. All right, and of course, we're taking a look at dollar yen. Did Japan intervene or not after the yen briefly hit 160? Tokyo isn't saying. This is the close on Bloomberg.
Hamas has before it a proposal that is extraordinarily generous on the part of Israel. And in this moment, the only thing standing between the people of Gaza and a ceasefire is Hamas.
U.S. Secretary of State Antony Blinken there earlier urging leaders of Hamas to reach a decision on Israel's ceasefire proposal. For more now, we're joined by Kelly Lyons, co-host of Balance of Power. So, Kelly, give us the latest. What kind of reception has that urging gotten?
Well, Scarlett, certainly the effort is underway. This is something that not just the U.S. is pushing for with Israel and Hamas at the table, but there are others involved in these negotiations as well, mediators, including the Qataris and Egyptians. Now, Antony Blinken is in the middle of his 7th trip to the Middle East since October 7th, really trying to push for this ceasefire deal to happen. He will also be traveling to Jordan and Israel after his days in Saudi Arabia. So it's really going to be a question, as he suggested, of whether or not Hamas accepts this deal. The New York Times has reported that Israel has reduced its demand of the number of hostages that need to be released by Hamas from 40 down to 33. In part, that is because Hamas has said it didn't have 40 hostages in the category of the elderly, sick, or women that they could release. So definitely still some negotiating going on. It's just going to be a matter of whether or not it can come to a conclusion, or there could be any further disruptions. Bloomberg is reporting today that the U.S. and allies are concerned that the International Criminal Court could soon issue warrants for Israeli officials, and that could potentially be disruptive and make Israel back away from any kind of deal. So certainly there are still a lot of areas of tension, but everyone is pushing to reach some kind of temporary agreement.
So the diplomatic channels, are they still open? I mean, between whoever I guess is representing Hamas and the Palestinian people and Israel?
there are diplomatic channels open really through mediators. The Egyptians and the Qataris are really the ones leading the way in these talks in Cairo. It is very much a question of whether all parties think that they are trustworthy in this. We have had indications here on Bloomberg from Israeli officials who have suggested that they don't view Qatar as a trustworthy negotiator. So certainly there is still some tension there. But officials that we have talked to in the last 24 hours have suggested really this is ultimately going to come down to Hamas's decision, that Israel has put something forward. It is starting to shift around its demands. It's just whether or not that this organization, that of course is deemed a terrorist organization by the U.S., is willing to accept the proposal.
All right, Kayleigh Lyons, co-host of Balance of Power, starting at the top of the hour alongside Joe Matthew for all your politics coverage right here on Bloomberg Television as we continue our coverage here on The Close and a look over at Japan and a wild day for the yen, which at one point surged back, which at one point actually broke the 160 level, a level we haven't seen going back to the 1990s. But the more dramatic move, you see it there on your screen, was the big drop that we saw back down to 155. And a lot of questions right now is who was behind that. Enda Curran joining us right now to talk a little bit more about this. And Enda, when you look at that chart there, I can understand why there's so much speculation. This had to be the government, or was there something else?
Well, we haven't had official confirmation for whatever reason from the government. The official who is in charge of intervention has made the point, though, that the government cannot look past excessive moves in the exchange rate. And that remained, as you mentioned, is clearly what happened last night. It hit that new low since 1990, past 160 mark. But then we had that turnaround in the exchange rate. Now, it was a thin market. It was a holiday in Japan, so it was probably a good time if the government did intervene to choose their moment. And what we do know is now back around to that 155 level. So it's taking some pressure off at face value. But remember, none of the backstory has gone away. The reason the yen is the way it is against the dollar is because of the U.S. rate story and the U.S. dollar story. So, this intervention could be considered a temporary win, but there's certainly a way to go yet in this story.
Okay, let's just zoom out a little bit here. And the Japanese currency hitting 160, the lowest in about 34 years, or weakest, I should say, in about 34 years. For the most part, for an export-driven economy, and I know that Japan certainly has enough domestic demand to sustain it, that's good news for Japan, isn't it?
I mean, it can be, but economists are divided on this because it depends where your production is based these days. Depends how much you're trading and invoicing in dollars. There are variables at play, but yes, on paper, a cheap currency helps your exports for sure. But the issue also is, of course, when you have a cheap currency, that you're importing a lot of tradable inflation. And that's especially true for Japan when it comes to oil and energy and food prices. And of course, we know Japan, as hard as it is to believe, but Japan has been sort of battling with inflation over recent years. And that's what's stoking all the debate about whether or not the BOJ might move. So there's a trade-off between what happens to exporters, what happens to importers. But the bigger concern, I think, for the government is less about the level per se. It's about the volatility, the gappiness of this move. No government likes to see their currency crashing, and that's probably what triggered some action here.
Yeah, absolutely. Here, it'll be interesting to see what happens when everyone comes back. Most of the folks Bloomberg talking to end up saying we're going to stay in this level for quite some time, particularly with those interest rate differentials. Enda Curran down in our D.C. bureau, a closer look here at that big move that we saw in the yen. All right, stick with us here on The Close. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. All right, we said this was going to be a busy week, so let's get right to it. A lot going on over the next 24 hours, and we're going to start in the world of crypto. CZ, you remember him?
Yes.
He used to head up Binance.
Well, he pled guilty to a couple things.
He did plead guilty to a couple things, and we're going to learn tomorrow how much, or if at all, what kind of jail time he might get.
Absolutely. Yeah. So in addition to paying $50 million, his firm paid about $4.3 billion, give or take $1 billion there. And he may face a prison sentence of up to 18 months, but U.S. prosecutors certainly want more than that.
Okay, that's not too bad, 18 months. I mean, that's not like SBF type time.
But SBF may have set a new level, right?
Yeah, but definitely an interesting fall from grace, particularly for a guy who seemed to take a lot of pleasure in SBF's downfall. At least for tomorrow, he might get his comeuppance. We'll have full coverage of that. We're also going to have full coverage of the start But the big event of the week, maybe the big event of the week, the FOMC meeting, 2-day meeting starts tomorrow.
Right. They begin deliberating. They'll be holding a lot of conversations. And of course, within the markets, the expectation is we're going to get a hawkish hold, or maybe even a pivot to something more hawkish.
Yeah, I mean, they're not going to change policy. At least no one thinks they are. But I think I'm more interested in they are going to have to announce some sort of shift in policy on the quantitative tightening and the idea here that might actually provide some relief here. But again, we'll have full coverage of that. And of course, a special Fed coverage on Wednesday on that back of that decision. We're also going to reconstitution of the Russell tomorrow.
Yeah, so the closing prices tomorrow really will be used for the 2024 reconstitution of all of the Russell U.S. indexes. So keep an eye on what happens tomorrow. Maybe we'll get another day like today where, in the end, not a whole lot happened.
And more earnings as well. In the morning, we get McDonald's, Coke, and Eli Lilly. After the bell, a few as well, including Amazon.
Amazon is the big one. Of course, we're going to look to see what AWS does. Starbucks, another look at the consumer and advanced micro devices and what it's doing in AI.
Thanks for joining us here on The Close. We will have full coverage of all of those earnings after the bell, better than anywhere else out there, right here on Bloomberg.